Shocking news during holiday time. CBAM might be suspended. Indian urea purchase tender finalized with higher price versus November and 3.6 million tons offers. USA attack at Venezuela influenced freight cost increase in the Western Hemisphere. All this and other news we will discuss in today's video. My name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is January 11 and this is the first weekly update of the year 2026. Let's have a look at the news of the first 2 weeks and see what are the next trends. Last week I have issued 2 interviews that I recommend you to watch. First one is the interview with Ed Cox, Global LNG editor at ICIS, where Ed uncovered trends for the natural gas market in the first half of this year. So don't miss the jazz. The other one is kind of fun. I experimented with the format and will be glad to hear your comments. It was my own interview conducted by AI. All questions were fully generated by AI, voiced by AI, so please have a look. Hope you will like it. Let's move to the news. Of course, the news bomb was dropped by European Commission last week. Pushed by French and Italian authorities, Commission announced that they will be looking into the option of suspending CBAM for fertilizers in order to sustain European farmers' competitiveness. Also, the Commission is considering waiving most-favoured-nation tariff for the imports of urea and ammonia, which is 6.5% and 5.5% respectively. For other products, the tariff might also be waived as a result of targeted analysis and decisions. Wow! Years of preparation, and now after 7 days of full-scale implementation, we see this. It is difficult to evaluate this discussion because it is not just a mess. I think it shows how unprepared in general are current European authorities to different challenges, unfortunately. But anyway, we as an industry need to move forward somehow. Most of the people to whom I talked last week agreed that CBAM suspension and especially retrospective application will be extremely hard to realize for the European Commission. Also, we need to take into account huge lobby of European fertilizers giants like Yara, for example. The company warned fertilizers community on Friday during its Capital Markets Day that if CBAM is suspended, they might put on hold multi-billion investment into US Gulf ammonia project. At the same time, waiving most-favoured-nation tariffs looks more realistic and can be used as a fast solution to calm down European farmers' community. This measure was already used in 2022 when Russia invaded Ukraine and fertilizers prices went over the roof. However, still the final decision is not taken, and the timing is also unclear. So, for now, European fertilizers imports are dead and will stay like that until the fog of uncertainty will lift. The other news that market was digesting was Indian tender unfolding. NFL received more than 3.6 million tons offers and accepted by suppliers as per end Friday last week were almost 980,000 tons. Most likely there will be more acceptances, so the total amount perhaps will reach 1.1 or 1.2 million tons. The price turned out to be very attractive for suppliers, $5 to $7 higher versus November tender, and reached almost $425 CFR to the West Coast and $427 CFR to the East Coast. Likely, Arab Gulf producers will supply up to 500,000 tons, Russians up to 300,000 tons, Southeast Asian, including Chinese, up to 250,000 tons, and Northern African up to 200,000. The netbacks will be sweet for all producers, so the limiting factor for them will be only understanding that in Q1 they will need spare tons for the markets with large appetite, like the US, and now Europe as well, most likely. Otherwise, I'm sure suppliers would confirm more amounts. Final tender results are expected this week. With such amount purchased, India likely will tender again sometime at the beginning of February to keep stocks healthy. Q1 is generally a quiet season, but Indian government will be very cautious with stocks this year after a disaster of last year. Situation in the physical markets was very quiet, as many market players are still on holidays. However, Indian tender results supported the sentiment, and sales were happening at the higher levels. There were several sales of small lots from Egyptian MOPCO at $450 to $55 level to open destinations. Egyptian producers will not rush to drop the price in order to stimulate the sales, as they will be waiting situation in Europe to clarify first. And in any case, they will be able to ship to the US market. In the Black Sea, business activity was limited, but still several small sales were done to Ukraine at around $400+ FOB and to Turkey at high $390s. In the Middle East, producers are happy with Indian netbacks at around $410 FOB. That's why Qatari producers sold a cargo last week at high $410s FOB. In Iran, only Part D operated at about half of its capacity, so producers sold a 30,000 tons cargo at $397 FOB for February loading. Other producers are offline due to gas supply curtailments, which are expected to end not earlier than mid-February. And taking into account current political turbulence in the country, I think it's difficult to predict what can happen. Situation changes literally every day. In Asia, Brunei producer BFI sold also a 30,000 tons cargo at $410 FOB for beginning of February loading. An important trigger of global price increase is USA, of course. Country purchasing has already started, earlier than usually, but perhaps it is not a surprise. Last year, importers purchased less product versus needed due to abrupt tariff regulation that was issued just in front of the active purchasing season. So this year, they decided to start early to make sure they have volumes available at target price level. But ironically, again, in front of the purchasing season, a shadow of potential tariffs loomed over the US market. Now, tariffs might touch supply from Russia, that was exempt of any import tariffs last year, and thus won a significant share in the US imports. Senator Graham's Russian sanctions bill might be voted this week, which will give President Trump power to impose tariffs at Russian imports, as well as secondary tariffs at trading partners who purchase Russian goods, all in first place. So it might shake the US fertilizers market again, but let's see how the story develops. Last week, barges changed hands in NOLA at $393 per short ton to $397. In Brazil, activity was limited last week after record urea imports registered in December. More than 1.1 million tons was imported, mainly from Iran, Nigeria, and Russia. Current CFR level is estimated at $415 to $20 CFR, and at this level, ammonium sulfate cost per nutrient is more attractive, so importers might switch more to sulfate again. Also, January is usually not a very active month in terms of imports, as country is in the harvesting mode, and safrinha purchasing is closing. In sulfate market, Chinese standard copro and granular price are still on par, in the range of $160 to $65 FOB. However, the demand, both domestically and export-wise, is decreasing, so most likely the price will drop as well. Generally, demand was subdued across the globe. Same was in nitrates market. European buyers are sitting on the fence, watching developments in CBAM and import tariff story. Brazilian demand is almost non-existing due to off-season. The only market which is actively purchasing is US, because the Yazoo plant of CF is still down, so importers are purchasing Russian product from Baltics. At the same time, Russia is focusing on its domestic season, so supply becomes more limited, and thus price increased slightly last week to $260 to $70 FOB. In the ammonia market, the activity was also subdued across the globe, but price sentiment is not turning to bearish despite January Tampa price drop. Continuous outage of Saudi Ma'aden MPC plant, as well as Sabic Al Jubail facility, pressure supply-demand balance east of Suez. And CBAM regulation is adding pressure west of Suez, as published at the end of December default emissions values put US producers in the uncompetitive position. It means that European buyers, whenever they come back to the market, will prioritize Northern African producers, as well as Middle East ones. Last week, as sales in Algeria was reported at $600 FOB to unknown destination. At the same time, positive news come from the US, where Gulf Coast ammonia plant seems to produce steadily for now. And Woodside Beaumont plant started production at the end of December. If all goes well, supply from these two plants will be an important add-on to the market. In Trinidad, nutrient plants are not operational. Canadian producer was supposed to resolve the issue with the government until December 31st. Otherwise, it would be treated as the company doesn't want to operate in the country anymore. So, after January 1, Trinidad National Gas Company issued an official notice instructing to stop gas supply and port access. Let's see which decision Nutren will take. Prices in India and Southeast Asia firmed a bit, but it is not a result of demand uptick, but rather contract prices catching up previous spot prices increase. In the phosphate market, activity was limited last week, while affordability remains the main issue again across the globe in 2026. Prices moved differently. DAP price inched lower, while MAP price increased. In India, DAP CFR price decreased more on the back of modern sales of 60,000 tons at high $660. This sales is a part of long-term agreement, while spot sales were absent. Most people in the market believe that price perhaps has reached the floor and will pick up from this level at the end of Q1. Purchasing strategy of Indian buyers is not clear yet. Either they will try to secure tons to avoid deficit of last year, or will wait to see the price dynamics. For now, stocks look healthy, and active distribution demand will emerge later in Q2 onwards. In the US NOLA, sales were limited and values hovered around $625 per short ton for DME and MAP for immediate supply, and $5 to $15 higher for February and March respectively. TSP barges were traded lower versus a week ago at $525 to $30 FOB. Affordability is the main issue limiting activity and keeping prices at this level. Market participants are not sure that this season will be better than last year, when consumption dropped quite significantly. Taking into account extremely tight global supply that is expected as of Q2 onwards, this might not happen. Market activity in Brazil was subdued, but MAP price increased by $5 to $630 to $40 CFR range. Again, the same problem, affordability, limits any purchases at this moment. Annual imports data shows that high MAP price level pushed the market towards other products, especially NPs from China, and also SSP. If MAP price continues to firm, this trend definitely will continue this year. However, Chinese product absence might cause a problem for Brazilian buyers. They will have to choose likely between expensive MAP and SSP or TSP without nitrogen content. European demand is seasonally slow. OCP reported sales of 17,000 tons of DAP to Western Europe for January loading at $755 to $75 FOB, higher than last done in December. But again, European buyers are suffering from low affordability, and volatility with tariffs and CBAM adds a headache to them. Moving to the fundamentals. European natural gas futures hovered at the similar level around 28.5 euros per megawatt hour. Norwegian supply is steady, as well as LNG supply, and temperatures remain relatively mild. There was a cold spell last week, but further in January seems like the weather will become warmer. Meanwhile, peace talks regarding potential Russia-Ukraine war finalization keep hopes high that a period of high volatility will end this year, and potentially certain softening of EU sanctions on Russian energy might happen. US natural gas futures dropped more than 5% to below than $3.2 per MMBTU, as weather forecasts turned milder and reduced expectations for heating demand over the next 2 weeks. Conditions are then forecast to turn warmer again, with limited cold confined mainly to northern regions later in the month. This outlook has outweighed supportive supply signals. LNG exports remain near record levels, with gas flows to major export plants averaging about 18.5 billion cubic feet per day in January. Domestic production, meanwhile, has eased slightly from December's record. Agricultural commodities futures moved differently last week. Wheat futures traded around $5.15 per bushel, as concerns over dry weather in the US plains supported prices. The rebound followed a slide to the lowest level since October late last week, and a brief pullback early in the week. Attention turned to upcoming USDA crop data after recent figures showed winter wheat condition ratings declined during December in Kansas and other plain states, renewing focus on crop health. Dry conditions at this time of year are largely seen as a psychological factor, as spring rainfall is more critical for determining final yields. Corn futures steadied around $4.4 per bushel, as demand reasserted itself faster than the market expected, while supply tightened. US export inspections and sales have run well above seasonal norms, with cumulative shipments this marketing year close to 926.7 million tons. At the same time, South American supply proved tighter than expected, as early Brazilian output was absorbed by domestic crushers and feed users, while farmers limited spot selling ahead of safrinha planting, and localized planting and weather risks constrained exportable tonnage. Strength across the grain complex amplified the move, with firmer soybean and wheat prices improving sentiment. So, strong export demand and slower farmer selling outweighed the broader narrative of ample annual production and kept futures elevated. Soybeans futures hovered around $10.5 per bushel, as traders positioned ahead of the USDA's January WSD report. Prices had been underpinned by continued Chinese purchases of US soybeans, with cumulative sales now exceeding 10 million tons and approaching the 12 million ton target previously cited by US officials. Private exporters reported significant new sales to China for delivery in the 25-26 marketing year, reinforcing demand expectations. In addition to export support, energy markets have provided a bullish backdrop. Crude oil prices have risen on concerns about supply disruptions and geopolitical risks, helping lift vegetable oil markets. Higher oil prices tend to support soybean oil, a key feedstock for biodiesel and other uses, which in turn lends additional support to soybean futures through the linkage between energy and oilseed markets. Moving to the shipping industry. The Drewry World Container Index increased by 16%, mainly due to rate hikes on Trans-Pacific and Asia-Europe trade routes. Spot rates on the Shanghai-Genoa increased 13%, while those on Shanghai-Rotterdam rose 10%. This upward momentum was driven by higher freight, all-kind rates implemented by carriers. Spot rates on Shanghai to Los Angeles surged 26%, and those from Shanghai to New York increased 20%. Capacity rose 5 to 10% on both Asia and North American routes and on Asia and North Europe Med routes in January. But current information regarding further perspectives points to soft volumes from Asia to the US, indicating that these large increases appear opportunistic and unlikely to last long. The Baltic Exchange Dry Index collapsed by 10% more to the level of July by 600 points due to weakness across all segments. The activity was subdued, as usual after Christmas-New Year holidays. The Capesize market delivered a mixed but generally softer week, with sentiment gradually weakening despite a brief midweek improvement in Atlantic activity. The Panamax market ended the week on a firmer footing following a muted post-holiday start, especially in the Pacific. Activity in Ultra-Supramax segment lacked positive impetus across the basins. Same picture was in the Handysize market, with limited activity across both the Atlantic and Asian basins, with overall market sentiment remaining negative. To sum up, news of potential CBAM suspension and most favored nations import tariffs waiving shocked European market, and buyers are waiting for official guidance from Euro Commission. At the same time, Indian Urea tender outcome indicates that nitrogen prices have found the floor in December and will pick up from now on further in Q1. Global urea supply begins to tighten, with USA stepping in with purchases earlier than usually, Iranian production being idled at least until mid-February, and Russian producers limiting export shipments amid sales to the domestic market, and effective drones attacks at fertilizers plants ongoing. Ammonium sulfate standard and compacted grades were traded at the similar level in China, but global demand was slow. Ammonium nitrate demand continued to be subdued amid CBAM in Europe and off-season in Brazil. Ammonia price was stable, supply east of Suez remained under pressure, while US Gulf Coast ammonia and Woodside plants produced successfully, adding to healthy supply west of Suez. Phosphate price seems to have touched the floor. However, low affordability across the globe remains a key challenge for the sector in 2026. Natural gas price in Europe hovered at relatively low level amid warm weather and steady supply. US price dropped more due to warmer weather across the vast majority of states. Agricultural commodities futures were mostly in green, but market eagerly awaits January WSD report that might shed more light at current plants conditions. Container shipping rates increased significantly amid container supply tightness during holiday times, but this trend might reverse quickly. Bulk shipping activity was subdued as usually after holidays break. So, let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.